Welcome back to the deep dive. Today we've got a mountain of source material, financial reports, articles, deep historical research, and we're going to pull it all apart to understand one of the world's most fascinating and frankly most unusual financial empires.
Our mission today is very focused. We are doing a deep dive on Berkshire Hathaway Inc. And you really can't just call it a company or an investment fund. It's so much more than that.
It really is. It's an American multinational conglomerate headquartered, famously, in Omaha, Nebraska. But its reach is, it's truly global. It touches almost every part of the modern economy.
And you have to start with the numbers just to set the stage.
Mm-hmm.
If you look at the 2024 financials, the scale is just, it's almost hard to comprehend.
So what are we talking about?
We're talking about total assets of over $1.154 trillion.
Wow. That's a number that just doesn't feel real. How do you even put that in perspective for someone?
Well, think about it like this. 1.15 trillion in assets is it's roughly the same as the entire GDP of a country like Mexico or Spain.
So Berkshire Hathaway is basically its own national economy.
In a very real sense, yes. And then there's the revenue. $371.4 billion in 2024. It consistently ranks, fifth on the Fortune 500 list?
Fifth, yeah. And the employee base is massive. It supports nearly 400,000 people globally, 392,000 to be exact. That's the sheer physical size of this machine.
But there's another part of the scale, a more philosophical part, and that's the share price.
The famous Class A shares, ticker BRKA.
Exactly. It has the highest per share price of any public company on the planet, and it's not even close.
We're talking, in August of 2024, it hit $700,000 for one share.
For one single share. You literally need a down payment for a nice house just to buy one piece of this company.
So why? Is that just a vanity thing?
No, not at all. It's actually a core part of their philosophy. It's a deliberate mechanism. The board, for decades, has been completely against stock splits.
And the idea behind that is?
The idea is that the prohibitively high price acts as a filter. It weeds out the short-term speculators, the day traders. It attracts only long-term, really committed investors. People who think of it as joining a partnership, not just making a trade.
That makes a lot of sense. It's a very expensive ticket to the club, but everyone in the club is there for the long haul.
Precisely. Now, before we dive into the wild history of how this all started, we should probably talk about the people, the architects.
Of course. You have to start with Warren Buffett, the chairman and CEO, and his indispensable partner for so many years, Charlie Munger.
Right. Munger was the vice chairman from 1978 all the way until he passed away in late 2023. They were the duo that really built and codified this whole investment philosophy.
But the future is already in motion, isn't it? The succession plan is one of the most watched, but also one of the most stable in the corporate world.
Absolutely. The sources are very clear on this. The successors have been in place for years, working right alongside Buffett and Munger. You have Greg Abel and Ajit Jain.
Okay, so break that down. Who does what?
Greg Abel is the vice chairman who oversees all the non-insurance operations. That's the massive industrial side of the business, the railroads, the energy, the retail.
And Ajit Jain?
Ajit Jain is the vice chairman for all the insurance operations. And as we're about to discuss, insurance is the absolute engine room of Berkshire. It's the capital machine that fuels everything else.
And the timeline for the handover is set in stone now.
It is. Buffett announced in May of 2025 that he's going to retire as CEO at the end of 2025. And Abel will be the one to succeed him.
So the handoff is happening very soon, which makes this deep dive, incredibly timely. We're looking at the legacy Abel is about to inherit. Okay, let's unpack this origin story. We're calling it the Accidental Empire, and it's a perfect name. For a company that owns massive railroads today, its beginnings are so humble. And frankly, they're the result of a big mistake fueled by pure anger.
It's an incredible story. Berkshire Hathaway didn't start as an investment vehicle. It started in 1839 as a textile manufacturer.
A textile mill.
A textile mill. The company we know today was actually formed from a merger in 1955 between Hathaway Manufacturing and Berkshire Fine Spinning Associates. And at first, it was pretty big. It had 15 plants, 12,000 workers, over $120 million in revenue.
But that industry was already in steep decline in the U.S., right?
Oh, completely. Intense global competition, rising labor costs. It was a tough business to be in. Our sources show that by the end of the 1950s, 7 of those original 15 plants were already shut down.
Which brings us to the big question. How on earth did Warren Buffett, who was already a very successful investor by then, get himself stuck running a failing business like this?
Well, the initial plan had nothing to do with running it. It was a classic arbitrage play. Buffett started buying up stock in 1962 at about $7.50 a share.
And his thinking was what?
His thinking was simple. The company was closing mills and liquidating assets. He figured that eventually they would offer to buy back his shares at a higher price, and he'd make a nice, easy profit. A quick, low-risk win.
But that's not what happened. The pivotal moment, the one that changed everything, came in 1964.
Right. Buffett had a verbal agreement with the manager, a guy named Seabury Stanton. He offered to sell his shares back for $11.50 per share. Stanton agreed. Verbally.
And then the formal offer came in the mail.
And then the formal written offer arrived. And the price wasn't $11.50. It was $11.37.5.
An eighth of a dollar, 12.5 cents.
Exactly. A tiny, almost insignificant financial slight. But that tiny detail is what changed financial history.
Because Buffett got angry.
He got furious. He said so himself later. He felt cheated. So instead of just taking the slightly smaller profit and moving on, he got his back up. He decided to go on the attack.
What did he do?
He started buying more stock. Enough stock to get a controlling interest in the company for the specific purpose of firing Seabury Stanton.
So he got his revenge. Stanton was out in 1965. But in the process, Buffett became the majority owner of a dying textile business he never actually wanted to own.
And that's the great irony. That's why we call it the accidental empire. What's so fascinating is Buffett's own critique of that decision. He has said many times that buying that textile company was the single biggest investment mistake he ever made.
He actually put a number on it, didn't he?
He did. He calculated that emotional decision denied him compounded returns of about $200 billion over the next 45 years.
$200 billion lost because he was angry about 12.5 cents. That's an incredible lesson.
It is. It's a reminder that even the Oracle of Omaha is human. He said if he just put that capital directly into insurance businesses from the start, instead of wasting it trying to revive the textile mill, the results would have been astronomical.
So what happened to the textile business?
He slowly wound it down. The last mill finally closed in 1985, a full 2 decades after he took control. The old company had to basically die so the new one could be born.
And that transition from a dying mill to a trillion-dollar behemoth, it really hinged on creating a completely decentralized structure. And you see that perfectly in their corporate headquarters.
Yes, this is such a defining part of their culture. I mean, you have this company, number 5 on the Fortune 500, operating all over the world. And its corporate headquarters in Omaha.
It's tiny.
It had only 27 employees as of the end of 2024.
27 people. To oversee more than $1 trillion in assets, that just speaks to a level of trust and discipline that you don't see anywhere else.
It's extreme decentralization. The philosophy is, it's pretty simple. We buy great companies, we keep the great management teams in place, and we let them run their business. We only step in on big capital allocation decisions. That tiny headcount in Omaha is a physical manifestation of that trust.
Okay, so that tiny corporate footprint can only work if there's a rock-solid philosophy guiding how all that capital gets used. So let's get into part 2. The investment philosophy and, crucially, the float engine. How did they actually turn that failing company into a money-making machine?
Well, the philosophy is often just called value investing. But Buffett's version is, it's a lot more specific than that. His main principle is a preference for what he calls evergreen businesses.
Evergreen? Meaning what exactly?
Meaning businesses that generate predictable, long-term returns and are ideally insulated from massive technological or social change. He wants stability.
And that explains his famous avoidance criteria, right? The things he won't invest in.
Exactly. Number 1, he avoids companies he doesn't fully understand. That's what kept him out of tech for so long until Apple, which we'll get to. Number 2, he's reluctant to invest in companies that are facing huge structural change. He doesn't want to bet on turnarounds. He wants to bet on stability.
And the third one is a big one. He generally avoids real property. You don't see Berkshire buying up office towers or shopping malls. Why not?
His reasoning is all about the economic moat, that durable competitive advantage. Real estate, for the most part, doesn't have one. The pricing is very precise, management is complex, and he believes it just doesn't offer the same long-term competitive edge as owning a great business or a financial asset with pricing power.
But the whole system doesn't just run on smart decisions. It runs on a massive river of cash that comes from the insurance subsidiaries. This is the famous float.
The float is the secret sauce. It's the absolute key to understanding Berkshire. Think about how insurance works. You pay your premium upfront for a promise that the insurer might have to pay out on later.
Right. I pay my car insurance premium today, but I might not have an accident for months or years or ever.
Exactly. And all that money, the premiums that Berkshire's insurance companies collect but haven't yet paid out in claims, that's the float.
So it's basically a giant interest-free loan from all their policyholders.
It is the ultimate strategic advantage. It's a huge pool of capital that isn't debt, so there's no interest, and it isn't equity, so it doesn't dilute the shareholders. They get to invest this massive float for their own benefit until the claims come due.
When did this become the central strategy?
It happened pretty early on. The first big non-textile acquisition was an insurance company called National Indemnity back in 1967. That was the start.
But it really scaled up with a few key acquisitions later on.
Massively. The crown jewel is Geico. Berkshire started buying into Geico in the 70s when it was in trouble. By 1996, they bought the rest of the company for $2.3 billion. Geico's direct-to-consumer model is a cash-generating machine that just feeds the float engine constantly.
And then came the even bigger reinsurance deal, Gen Re.
Right, Gen Re, acquired in 1998 for $22 billion, though that one came with a lesson.
He felt he overpaid for it, right?
He did, and he admitted it publicly. But that's the thing about their model. Even a perceived overpayment for a quality business that generates a massive, consistent float can be absorbed by the strength of the whole conglomerate.
And speaking of paying for things, there's a great story from the 2022 Allegheny acquisition that really shows his attitude toward Wall Street.
Oh, it's a classic. They bought Allegheny, another insurer, for $11.6 billion. But as part of the deal, Berkshire actually reduced the purchase price by the exact amount of money Allegheny had paid its investment bankers in fees.
So he was essentially saying, I'm not paying for your bankers.
Exactly. It was touted as a perfect example of Buffett's famous disdain for the investment banking profession. He made sure that Berkshire shareholders weren't funding what he saw as unnecessary middleman fees.
This is where the float engine gets really, really interesting. Because when you have that much low-cost capital, you can become the lender of last resort when everyone else is panicking. Let's talk about the financial crisis playbook.
This is where you see the true power of the float. In 2008, when the financial world was collapsing and credit markets were frozen solid, Berkshire could step in. They had cash when no one else did. The most famous example, of course, is Goldman Sachs.
September 2008, the height of the crisis. He invested $5 billion. That was a huge vote of confidence. But the terms were, they were not exactly generous.
Not at all. They were incredibly favorable to Berkshire. He bought $5 billion in preferred stock that paid a guaranteed 10% annual interest.
So that's $500 million a year just in interest payments flowing into Berkshire.
Guaranteed. And on top of that, they got warrants, the right to buy 43.5 million shares of Goldman common stock at a hugely discounted price of $115 a share.
So he got a massive income stream and massive future upside. What did they end up making on that one deal?
The final profit was immense. Just on the preferred stock, they made about $1.8 billion. But the real win was on the warrants. The profit from those was estimated at over $2 billion. So all told, you're looking at a profit of more than $3.8 billion. It was a masterstroke, made possible only because they had the cash ready.
And they ran basically the same play a few years later with Bank of America?
The exact same playbook. In 2011, Bank of America was in trouble. Berkshire swooped in, $5 billion in preferred shares, this time paying 6% interest, still a sweet $300 million a year.
And I assume a boatload of warrants.
A massive boatload. Warrants for 700 million common shares at just over $7 a share. By 2017, that position had generated a profit of around $12 billion, and that's not even counting the billions they collected in interest payments along the way. It's the perfect demonstration of having dry powder when everyone else is running for the hills.
Okay, so now we move to part 3, the vast portfolio itself. This is what all that float and all that disciplined thinking has built over decades. It's just the sheer breadth of what they own is incredible. Let's start with the fully owned subsidiaries, the businesses Greg Abel oversees.
Right. These are the engines of stable day-to-day earnings. You can really group them into a few big categories: infrastructure, essential manufacturing, and then consumer retail. These are the definition of those evergreen businesses we talked about.
The infrastructure giants are, well, they're literally the backbone of the economy.
The flagship is BNSF Railway. They bought the rest of it in 2010 for $26 billion. At the time, that was their biggest deal ever.
And owning a railroad, that is the ultimate economic moat, isn't it?
It really is. You can't just go out and build a competing railroad. The barriers to entry are immense. So BNSF has this incredible, predictable stream of returns that's tied directly to the health of the U.S. economy and global trade. Plus, it's a fantastic hedge against inflation.
Then you've got the whole energy division, Berkshire Hathaway Energy, or BHE.
BHE is a monster in its own right. It owns huge utilities like PacifiCorp in the U.S. and Northern Power Grid in the U.K. And utilities are the classic evergreen business. People need to turn on the lights and heat their homes no matter what the economy is doing.
And that division also includes a huge real estate brokerage, right?
Yes, Home Services of America. It owns brands like Long & Foster. It's another move into a stable, essential, regulated industry. That's the theme.
And you can't talk about infrastructure and logistics without mentioning the truck stops.
Pilot Flying J. They acquired the final piece of it in 2024 for $3 billion. Owning a major truck stop chain is a critical link in the supply chain. It complements BNSF and just provides another steady stream of revenue tied to transportation.
All right, let's shift to manufacturing and materials, the sort of unseen essentials that make everything else run.
The biggest one here, by far, is Precision Cast Parts Corp, or PCC. That was a $32.1 billion acquisition in 2016. It was a massive deal.
And what do they make?
They make highly complex, high-tolerance metal parts for things like jet engines. It's a classic moat company because the expertise and regulatory approval required means there's almost no competition.
But this deal is also a good reminder that not every swing is a home run.
It is. In 2020, Buffett came out and said he overpaid for PCC. They ended up taking a write-down of about $10 billion. But here's the key. The strength of the overall Berkshire machine is such that it can absorb a $10 billion mistake and just keep moving. It shows how robust the model is.
What other big industrial names anchor this part of the business?
Well, you've got a lot of companies that make the basic stuff of industry and construction. Lubrizol, a chemical company they bought for $9 billion. Johns Manville, which makes insulation. Shaw Industries.
Which is the world's biggest carpet manufacturer.
The biggest, by far. Again, not a flashy business. Insulation and carpets. But they are essential. Shaw has this huge moat because of its scale and distribution networks. You add in Mytech, which makes products for the building industry, and Duracell batteries. These are all just the fundamental building blocks of a modern economy.
Okay, let's go to the consumer side. This is where you find some of the most famous brands. And we have to start with See's Candies.
See's Candy is the legend. It's Buffett's favorite case study. They bought it way back in 1972 for just $25 million.
And the return on that has been astronomical.
By 2019, that $25 million investment had returned over $2 billion in cash to Berkshire. That's an 8,000% return. It's the perfect example of a brand with pricing power.
Meaning people love it so much they'll pay more for it every year.
Without even blinking. They can raise the price of a box of chocolates year after year, and people just keep buying it. That is the definition of a moat. And it's highly seasonal. About half its revenue comes in November and December. It's a cash machine right when they want it.
The consumer portfolio also has staples like Dairy Queen.
Acquired in 1997 for $585 million. And then a whole stable of home furnishings companies. Nebraska Furniture Mart, Jordan's, R.C. Willey.
And we can't forget the service sector holdings, which are quite diverse.
Very diverse.
Yeah.
You have NetJets, which is fractional ownership of private jets, a luxury service. Then you have Flight Safety International, which is a global leader in pilot training. And McLean Company, a massive logistics and distribution business they bought from Walmart that keeps shelves stocked all over the country.
Before we pivot to the stocks, we should touch on the media ventures because that shows an interesting strategic shift.
Right. They used to own a lot of local newspapers through BH Media Group, but Buffett saw the writing on the wall for that industry. So in 2020, they sold most of them to Lee Enterprises. But here's the clever part. They also became a key lender to Lee, loaning them over $500 million. They went from being an owner in a declining industry to being a secured creditor. It was a very strategic retreat.
Okay, let's pivot now to the other side of the portfolio, the one that gets all the headlines. The major securities holdings, funded by all that insurance float.
And this portfolio is, it's really dominated by one massive name, Apple.
Which was a famously late investment for Buffett in the tech space. He always said he didn't understand tech.
But he saw Apple differently. He didn't see it as a tech company. He saw it as a consumer products company with the best economic moat in the world. The stickiness of the iPhone ecosystem gives it incredible pricing power.
He started buying in 2016, and by 2022, it was, what, over 40% of their entire stock portfolio?
A huge concentrated bet, which means any move they make in Apple is a massive market event. So what does this all mean for today? It means what they did in 2024 was seismic.
They sold a huge chunk of it.
A huge chunk is an understatement. Our sources show that in the second quarter of 2024, Berkshire cut its Apple stake by nearly 50%. They sold $75.5 billion worth of stock.
Wow. That's not trimming a position. That's a major strategic shift.
It absolutely is.
Yeah.
And it's what instantly ballooned their cash reserves to that record $276 billion. It signals that they either see much better opportunities elsewhere or, maybe more likely, they think Apple's valuation has gotten a little too high.
Beyond Apple, though, the portfolio is anchored by these big financial staples.
Exactly. They own over 20% of American Express, a position they've held for decades. They own a big chunk of Bank of America, which they got on those favorable terms we discussed. They own a piece of Moody's ratings. And then there was the recently revealed mystery stock.
Which turned out to be Chubb, the insurance giant.
Right. A nearly $7.5 billion stake in Chubb. These are all foundational pillars of the global financial system.
And in energy, they're heavily concentrated in traditional oil and gas.
Very heavily. It's a bet on enduring global demand and a hedge against inflation. They own a big stake in Chevron and an even bigger one, almost 27% in Occidental Petroleum.
The most surprising part of the portfolio for me is the international play, the big investment in Japan.
The Sogo Shosha, the big Japanese trading houses. This is a really interesting and rare move outside the U.S. for them. These companies are totally different from a U.S. conglomerate. They're involved in everything from energy and commodities to global logistics.
So what's the strategy there?
By buying a piece of the 5 largest ones, Itochu, Mitsubishi, Mitsui, and so on, Berkshire gets this incredible diversified exposure to global trade flows and commodity markets that it just can't get from its U.S. holdings. By 2023, they'd up their stakes to over 7% in each. It's a big bet on the future of global supply chains.
Finally, we have to look at the sales and the regrets, because that's where you learn a lot. We have to talk about the airlines.
Oh, the airline saga. It was a huge reversal for Buffett. He called the industry a death trap for investors for years. Then in 2016, he dove in, buying stakes in 4 major airlines.
And then the pandemic hit.
And in April of 2020, he sold everything, liquidated the entire position at a big loss. He just decided the pandemic had fundamentally and permanently changed the risk profile of that business.
He's also been very open about the Paramount Global investment being a mistake.
A huge mistake, by his own admission. He invested $2.6 billion in 2022 and sold it all by May 2024 at a substantial loss. He took full personal blame for misjudging the streaming wars.
We've also seen them sell based on geopolitics, which is a newer factor.
The TSMC sale is the perfect example. They bought $4 billion of the Taiwanese chipmaker in 2022 and then sold almost all of it in the next 6 months, explicitly citing the rising geopolitical tensions around Taiwan. It shows that political risk is now a huge part of their moat calculation.
And the portfolio is still being actively managed. It's not static.
Not at all. The last quarter of 2024, for example, they bought over $1 billion of Constellation brands. But at the same time, they sold their entire stake in Ulta Beauty after only owning it for 6 months. And they got rid of all their S&P 500 ETFs. It shows they are constantly reevaluating, and they are not afraid to admit a mistake and get out quickly.
Okay, let's move on to part 4, which is the corporate governance and the culture, because it's just as unique as that $700,000 share price. We have to talk about the 2-tier stock structure.
Right, so we've established the Class A shares are intentionally expensive to attract long-term investors. It's an anti-speculation tool.
But they had to create the Class B shares in 1996, and it was to fight off copycats, right?
That's exactly it. Other investment firms started creating these trusts that were basically designed to give people cheap, fractional access to Berkshire. They were trying to piggyback on the name.
So to stop that, Berkshire created its own lower-priced option.
They did. They introduced the Class B shares, the BRKB. Originally, they were a fraction of the price, but after a split in 2010, they're now priced at 1/1500th of a Class A share. It makes ownership accessible to almost anyone.
But that accessibility comes with a trade-off in terms of power, doesn't
A
it?
huge trade-off. This
Yeah.
is the critical part for governance. A Class B share has only 1/10,000th of the voting rights of a Class A share.
1/10,000th. Wow.
Yeah. It ensures that the effective voting control stays concentrated with the long-term, high-value Class A shareholders who are most aligned with the founding philosophy. It's designed to maintain stability.
And that philosophy of sort of extreme frugality and long-term thinking, it starts right at the very top with executive pay.
The contrast here is just iconic. Warren Buffett's salary has been fixed at $100,000 a year for 35 years.
$100,000 to run a trillion-dollar company.
It's unbelievable. He gets no stock options, nothing like that.
Yeah.
Just about $300,000 a year for security services. It's a powerful signal.
And what does that signal to everyone else?
It signals that he sees his job as a steward of capital, not an executive trying to maximize his own pay. His wealth is tied entirely to the performance of the stock that he owns. It sets the cultural tone for the whole organization.
But you have to contrast that with the pay for his successors, Greg Abel and Ajit Jain.
Right. They're compensated like the top-tier global executives they are. Abel and Jain each get a salary of $20 million a year plus a potential bonus.
Yeah.
The message is, the operational leaders are rewarded handsomely for their performance, while the chairman maintains that symbolic minimal pay.
And this all leads us to the future. The succession plan is now very clear and very public.
It's the biggest governance change in the company's history. Abel and Jain were made vice chairman in 2018. Abel was formally named the successor in 2021. And with Buffett's announcement, the timeline is set. Abel takes over as CEO at the end of 2025.
Finally, we can't talk about the culture without talking about the annual shareholders meeting. It's less a meeting and more of a festival, right? The Woodstock for capitalists.
It's completely unique in the financial world. Over 40,000 people descend on Omaha, Nebraska every year for this thing. And the main event is a 6 or 8 hour Q&A session where Buffett and his team answer questions directly from shareholders, totally unfiltered.
It's all about transparency, but they also make it fun. The introductory cartoon they play every year is legendary for setting that tone.
Oh, they're brilliant. They use those cartoons to show they don't take themselves too seriously. Like in 2004, they had a cartoon with Arnold Schwarzenegger as the Warrenator, trying to travel back in time to stop Berkshire from being formed.
And they're always sports cameos and spoofs, right?
Always. In 2007, Buffett was playing basketball against LeBron James in the cartoon. They used them to poke fun at their own subsidiaries, too. In 2008, there was a cartoon where Charlie Munger becomes president, and his solution to climate change is for everyone to eat more Dairy Queen.
It's just a brilliant way to maintain this incredibly approachable, almost folksy culture for what is, at its heart, one of the most powerful and disciplined financial machines ever created.
But, this raises a really important question. For all the talk about integrity in this folksy culture, the sheer scale of this decentralized empire means it's not immune to controversy. We have to look at the scrutiny some of the subsidiaries have faced.
Right. When you own hundreds of companies in highly regulated industries, you're going to face legal and regulatory challenges. And our sources detail a few key ones. The first has to do with lending discrimination at their Home Services of America division.
That's right. In 2022, a subsidiary called Trident Mortgage Company had to pay a $20 million settlement. This was after the Department of Justice and the Consumer Financial Protection Bureau alleged redlining.
And what does redlining mean in this context?
The federal investigation alleged that the company wasn't providing equal access to mortgages in certain neighborhoods, specifically communities with large Black and Latino populations in and around Philadelphia. It's a serious allegation that highlights the challenge of making sure that ethical standards are met across such a vast, decentralized network.
And there have also been allegations of aggressive lending in the manufactured housing business.
Yes. In January of 2025, the CFPB sued another Berkshire subsidiary, Vanderbilt Mortgage and Finance. The lawsuit alleges that they were using aggressive tactics to push borrowers into loans they couldn't actually afford.
With pretty severe consequences for those borrowers.
According to the allegations, yes. The result was significant financial hardship, excessive fees, and in some cases, people losing their homes or going into bankruptcy. These kinds of issues really challenge that clean, conservative image of Berkshire.
And finally, let's touch on the environmental concerns around the energy division, BHE.
A Reuters investigation in 2025 really focused in on this. While BHE has invested a lot in renewables, the report was very critical of the fact that it still operates several of the most polluting coal-fired power plants in the entire country.
And it's the timeline for those plants that's the real point of contention, isn't it?
It is. Critics point out that BHE plans to keep some of these high-emission coal plants running until at least 2049. That very long timeline raises serious environmental and public health concerns that, seem to run counter to the company's image as a long-term steward of capital.
These controversies are a really necessary counterpoint. They show just how hard it is to manage a conglomerate of this size, where the actions of one subsidiary can have these major national repercussions.
You absolutely do. And speaking of scale and strategic choices, this all brings us back to the biggest financial signal the company is sending right now, that massive pile of cash.
Right. Let's revisit that number because it's just astounding.
As of mid-2025, the sources show Berkshire was holding $344 billion in cash and treasury bills.
344 billion. That is by far the largest cash position of any public company in the US.
And that huge $75 billion sale of Apple stock is a big reason why. It sends a pretty clear signal that finding big, high-quality businesses to buy at what they consider an attractive price has become almost impossible in the current market.
What a deep dive this has been. I mean, we've traced the entire story of Berkshire Hathaway from what Warren Buffett himself called a monumentally stupid decision.
All over 12.5 cents.
Exactly. A mistake born of anger that accidentally forced the creation of this trillion-dollar conglomerate we see today.
We've seen how that accidental empire was built, not just on brilliant stock picks, but on this disciplined philosophy fueled by the massive float engine from the insurance businesses. That's what allowed them to be the lender of last resort in a crisis.
And we explore the sheer breadth of what they own, from things like carpets and insulation to entire railroads and power grids, and then the dynamic stock portfolio, which has been defined recently by that massive strategic sale of Apple stock.
And all of this is happening at this critical moment of transition. The governance is about to change for the first time in decades, with Greg Abel set to take over from Buffett at the end of 2025.
He's inheriting a perfect machine that is it's drowning in cash.
He is. And that brings us to our final provocative thought for you to think about. That record cash reserve, that $344 billion, it sets an unbelievably high bar for future acquisitions. The question isn't just how Greg Abel will use it. It's about the opportunity cost of just letting it sit there. Does that cash become the ultimate strategic weapon if the market goes into another panic, giving him incredible power? Or does the drag on returns become so great that shareholders start demanding he spend it, maybe forcing him to lower the very standards that made the empire so successful in the first place? It is the ultimate inheritance, and it's the ultimate challenge for the next leader of the accidental empire.